It's a privilege for me to be here moderating what I think is a panel of, truly knowledgeable and thoughtful people. And I think we should use the opportunity that we have, since we have people who themselves have created in their careers significant amount of wealth at the organizations they've worked and been involved in a process where it has been created. I'd like to go around the table to ask each of them, maybe spend a couple of minutes telling us what, in their opinion, are the most significant things that lead to the creation of wealth in the context of a corporate setting. So, Amit, would you like to set us off?
Thanks, Sanjoy.
And this is your personal experience.
Sure. So I think my personal experience in the first innings of my career was really with DSP Merrill Lynch, which interestingly did land up being a great story of wealth creation for the Kothari family. And that too in an industry where, which is today notorious for not having created wealth. I think my simple takeaways when I reflect back on what really drove wealth creation at DSP was really just getting the basics right. I think Hemendra was an incredible leader who was very clear that financial services was essentially a business about people, and so he really focused on making sure that he got what he truly believed were the best possible people in the business. Creating the right incentive structure around them, ensuring that greed did not get the better of them in an industry where greed often creates great value over short cycles, but can destroy institutions, as we've seen it happen in the West over longer cycles. And then I think another theme which I think was unique was really thinking hard about building strategic differentiation. Being very clear on what does it take to be ahead of the market and reinvesting some of the gains that you get, from that in being ahead of the curve. I think there was an incredible focus of that at DSP as opposed to just short-term profit maximization, just making sure that money kept going in on making people investments, on doing things which were atypical in the market at that point of time in order to build that moat that Raamdeo keeps talking about. And the third takeaway actually is very interesting, which is a good takeaway again from the wealth creation survey, which is essentially businesses with high return on capital employed. The odds are generally, the tailwind is behind you and the odds are generally in your favor. Avoiding making investments in really capital intensive stuff was something that I think, DSP was great at. And that I think enormously helped again create wealth on a sustainable basis.
Amit, if I heard you right, I think in essence what you said, and please correct me if I'm wrong, is clarity of purpose, taking the long view, and the ability to do business, grow the business without having to put in large incremental sums of money to achieve that growth. These were, to your mind,
these were truly the unique factors.
Mr. Sighvi, you also have had a very privileged perch. You have done wonderfully in creating some outstanding organizations, and as a banker in your second innings, you've also been associated with some of the best names in this country. Would you like to share what you have seen and what you believe leads to, whether you call it value, wealth, whatever phrase you choose to use, which differentiates really top drawer companies from the less than rewarding companies?
Well, I'll dwell more on my experience with Ambuja. I'll just first start with one basic factor, which was that when I joined the company, there was an IPO just happened then for a total market cap of $5 million. And when in 2006 the company was sold out to Wholesale, the total valuation of the company was close to $6 billion. So I saw a journey from 5 million to a 6 billion, 1,200 times in just about 22 years. And a sector which I have a great respect for Raamdeo and very huge affection for him. I've known him for almost 25, 30 years, but he never liked that sector at all. So to create the wealth in a sector which Raamdeo never liked, I think to a very large extent, I feel
that's against the odds. It's almost wrong.
Let me just come back to this, that what we did in Ambuja as compared to, and I remember there were about 6 more IPOs at the same time in '86. So I'm taking you back from probably the time when you were not even born. But I just want to dwell on that how you can create value over a period of time in a very mundane, very commodity business. I mean, cement is a completely commodity business, as you would all know. But I think one thing which differentiated us from others and where we constantly and continuously really worked on, that in a commodity business, produce cement as a commodity as far as the factory is concerned, but don't sell cement as a commodity in the market. What does that mean? It's exactly what Raamdeo was talking about, creating economic moat on a sustainable basis. That means keep your costs low. Produce cement as a commodity. That means every ton of cement what you produce has to be lowest cost producer. But don't have a mindset when you are selling in the market, because then you can't just be throwing the commodity and other guy is buying a commodity and he's going to really squeeze you out, because then you have squeezed both sides, on the side of the cost and on the side of the pricing. So this is what we learned hard way, because we were extremely competitive in that market. And cement market, mind you friends, continues to remain very competitive. In fact, it has become more competitive now than it was ever before. But in that market, to consistently make money, I think this is the only way you can create both profits, or sometimes I would use the word superlative profits, but more importantly, create that kind of an entry barrier. But otherwise, how do you create an entry barrier in cement? Everyone can find limestone deposits and start a cement plant. But you create an entry barrier by way of keeping your costs so low and sell an industrial product as more as a brand. Second point which I would just like to dwell on, and I think taking a cue from where Amit left, that not to invest money into capital intensive situations and then keep your, as you rightly said, that a company, to my mind, a AAA company is a company which never should borrow money. Why do they need rating? I don't know. Yeah. So but being in a capital intensive industry where I come from, in Ambuja, I think it was a very important factor to look at how judiciously you really keep an eye on your capital employed. Because it can guzzle, and one wrong decision can take you completely away. You've got to be having a strategy which is going to work on a long term, and in a commodity business like this is only keeping the cost low. Don't sell your product as a commodity.
Right. Thank you very much. I think, what you said is something that is now part of accepted wisdom. They actually teach this at the business schools, that one of the 3 sources of competitive advantage is being the low cost producer, and that's exactly, so you're absolutely spot on. Now, Raamdeo, I have a question for you. So, Mr. Sighvi made a wonderful point. Indian companies, and I used to be staggered, but I still am staggered by lots of things, but they used to say, we're doing a wonderful thing. We're using retained earnings to pay down debt. I mean, that is the closest thing to absurd that I have seen in my life. Using money which costs you 16% to pay off money which costs you 6%. But they all love to say we've become debt free because we've paid off our debt using retained earnings. That is capital allocation at its worst.
Sure.
You can't beat that.
But we have seen real bad wealth capital allocation in last 7-8 years in the size and the I think it started with Mr. Alan Mittal becoming world's 3rd largest richest man, and I think somewhere some of the Indian counterparts they also wanted to bridge the gap very quickly, and in that process, and probably there was some problem in growing in India also. So at least that was the context in which a lot of very large acquisitions happened, and I think one other thing also was that the way the global economy and local economy was moving between 2003 to 2007, it was very, very rapid growth in the economy. So at that point of time, the entrepreneurs who had not seen this kind of a cycle, they got engulfed in cycle, and they bought, the market cap of their own company got into their head, and they started acquiring companies, keeping the market cap in the mind rather than looking at the balance sheet.
Right.
And then what happens is, when you buy a 10 or 12, $14 billion of company, of course the banker has the job. I mean, he comes in very smartly and he pitches how exactly you are going to, how nice it is. You are
Synergies. He shows you the synergies.
Synergies and the cost of capital, literally no cost of capital, 3%, 2%, and sir, here is your EBITDA and only
how much you will save in the next 3 years, all of that. Yeah, okay.
So all kinds of, so he is very successful in collecting his $500 million fees.
Raamdeo touched upon something which is really important in understanding corporate longevity and in making money over time in the most sensible way, which is without trading too much, without having to make too many decisions. And it's a concept that he labeled in the presentation the competitive advantage period. He also spoke about how that competitive advantage period can be extended. And if it does get extended, then, you know, Einstein's 8th law comes into place, the power of compounding. Because you just stay with it and it continues to make more and more and more money. It's like a, you know, some kind of a magical compounding machine. Now, my question to all of you is, you pointed out one way to have that competitive advantage, which is being the low-cost producer. Would you people also like to share other things or other methods by which or how this competitive advantage is brought about, number one? B, how it's sustained. 3, can you make it become larger over time? Because then it's the ultimate. It's like, you know, the best you can do. So what are, and you can use examples to illustrate the point or whatever, but would you like to talk about these 3 things vis-a-vis the competitive advantage and the period of competitive advantage?
You know, so I think Anil made the right point on cost always being a critical competitive advantage. And I think on cost, what we have generally seen is businesses that are best in class as value creators, for them cost is never static. And in fact, you know, often when you go into these companies, they talk about continuous cost improvement, which is, you know, it's always a downward facing slope. And I think this is very important in an inflationary environment like India, because we very easily get lulled into thinking of cost inflation, but actually customers in very few industries actually give you price inflation. So I think continuous cost improvement is clearly important. But the other thing that emerges, you know, from the study and, you know, hits you in the face year after year is the strength of brands. You know, I think again, and brand building is a very, very tough thing to do. And Anil, I'm sure, can talk to it. But I was once speaking with, you know, Mr. Keki Dadi Seth, and he was explaining to me how, you know, Unilever used to build brands. And it was amazingly insightful. He used to talk, he explained to me that when you're really trying to build a brand, the first 5 to 7 years, you should expect no profits at all. And you may even invest 25 to 50% of revenues in that period in creating a sustainable brand, only to reap its benefits, you know, between years 7 and 20. And I think how many people really have the ability to look so long term? You know, as shareholders, we are so impatient about, you know, this quarter, forget alone this year. But what it takes to build a sustainable brand, and once you've built that brand, you know, you enjoy its benefit in almost in perpetuity. So I think the second critical thing is just the strength and the power of brands, and the need to keep investing in them is, in my view, a critical source of competitive advantage. Let me pause there. I have a few others, but I'm sure, you know, my colleagues have some.
No, I completely agree with Amit, and another example which comes to my mind is either Asian Paint or Titan. If you look at these two, and Titan, more importantly, they did not use the Tata name. They didn't even say it, you know, Titan by Tatas. I mean, it was never there. It was Titan, and how it became a household name over a period of time and on a very sustainable model. And look at even Asian Paint. In fact, I don't know whether in this room anyone would recollect that it was Gattu, which was Asian Paint's icon, which was there. I mean, those who are 30, 40 years into corporate world would recollect that how powerful was Gattu. But they got over the Gattu and got into Asian Paint in a different manner. But I think the theme remained that Indian company reaching to that level of both brand building and efficiency, and continuously doing it for the last 25, 30 years. In fact, Asian Paint today would be one of the most expensive companies into like Titan and Asian Paint. If you look at two consumer brands on a sustainable model, which is highly competitive. In fact, you look at the paint industry, which had all foreign brands. You had ICI, you had Buzzer, you had Nicholas.
So the audience always likes to go away feeling that they'll get richer in the near future, Mr. Sighvi. I know I'm trespassing ground here, but can you think of any emerging brands?
I think a bunch of them in the consumer retail space, but they're all still relatively small. And I think the point I was making on brand building is that it's often actually a 10-year journey before you are able to really call it success, because in the interim, if the guy loses interest or some family member joins and he thinks he's spending too much and he should go public and maximize, you'll basically see the backlash.
Absolutely. So
I think we should be careful about calling success stories a little too early.
Okay.
But I want to make one other point on in response to your question. And I'll make this also in a little bit in relative context. There's some examples of it in India, but you see it typically a lot in the difference between how wealth creation happens in the West versus in the East. There's a concept which doesn't get talked about a lot in India, which is relative market share. We always talk about market share, we don't talk about relative market share. And you generally find that businesses where owners have been very thoughtful about what drives competitive advantage because of relative scale, generally see much better returns and much more sustainable returns over a period of time. And, so as opposed to saying I'm the largest market share player with 10% and defining the market as India, if you actually were focused on Western India and you actually had a 40% market share but a 2% national market share, but that business was essentially a regional business, you'd actually see much more value creation. I would argue, even without seeing anything else in that business, you'll see much more value creation over periods of time. In India, there's been this, general tendency to, diversify. So when you allocate your capital, you spread it very, very quickly. You diversify either geographically or you diversify across industries, but there's a general tendency of diversification as opposed to doubling the bet on something that you're really doing well in a more focused manner to build that moat that again Raamdeo talked about in his presentation.
Right.
I think if we see more and more of this emerging, you will actually see some dramatic value creation. There are examples even today, Raamdeo talked about again examples within the same industry. We've seen such examples. Apollo is a good example of a hospital company which has done a great job of not caring about its national market share, but thinking more about, relatively its share in the South, even in South in two real clusters versus others who have tried to go more national, and you can see the difference in value creation.
Right. Raamdeo, you're a great fan of Bruce Greenwald. And something that he said and something that we're talking about here is closely related, isn't it? That you need to have profitable growth and you don't need to, he also spoke about it, not diversify, and so extending the competitive advantage period. Would you like to sort of share those thoughts with us?
Yeah, so what I'm saying is that some of the companies, housing finance companies, this particular segment has emerged as a very large wealth creating company, and it's a very large and predictable business model. And still the mortgages to GDP is still about 10% outstanding mortgages. So, and most of the countries, even China and all, have gone to 50-60%, and some countries it is even 100 and over 100%. So we have a long way to go. A lot of houses to be constructed, and looking at the current real estate prices, even most of the guys, they cannot fund it upfront. So clearly the mortgages are the way to go, whether they are salaried or non-salaried.
So penetration is low, huge untapped opportunity, you continue to do well. Okay.
Now, so what we are saying is, of course, HDFC laid the foundation, Mr. Parekh, HT Parekh in early 80s. And so we have seen a birth of a huge giant. Now in this space, under its shadow, say like Guru Finance, small company, for it struggled for 11, 12 years under different managements, different kind of concepts or whatever. But you see the competitive advantage emerging. The company was earning around 11, 12%, 15%, And then suddenly you see that company going to 25, 30, 35%. So 30, 35, in fact, profitability is higher than that of HDFC today on its own kind of chosen. But the size is minuscule. Today it is at 4,000 crores and HDFC might be 1.5 lakh crores in terms of outstanding. Can this company extend this current competitive advantage, which is looking to be absolutely very high, ROTA of more than 2%, 2.5% on the assets they have? And they're catering not to the same salaried staff. They're in fact catering to non-salaried kind of people.
Right.
So this advantage which they have created, which is very small right now, how big can it become?
Right.
You know, so of course they have gone in the process they have created certain management processes or the way they acquire clients, the way they appraise. The delinquency level is actually lower than that of HDFC.
Right.
So clearly there must be some
So maybe a
edge.
differentiating factor for them is how they select credit or their credit selection
so
process.
what I'm saying, it is reflected in the financials.
Right.
Okay. And so these kind of companies, if you see, and second is the value migration, the concept of Adrian Slavetsky, where you see the huge pockets of value moving from one side to other. Like from a wired companies, the telephony is important, but MTNLs and BSNLs have become thing of the past.
Right.
And on their demise, you have created one of the largest wireless population. So there, again, the theory of networks work, and you have to upfront invest, and when you start making money, you start making huge money. And that's where the Bharti came in. So, you know, this creation of new competitive advantage could be in a secular business like housing finance. You can do it on a death of one segment of this thing, but the human need of telephony remains.
Right.
So it is met by
Move to the next.
Move to the next.
I'd like to conclude with something I read recently and which struck me as I was speaking today. It's by this French philosopher called Voltaire. He said, doubt is an unpleasant condition, but certainty is absurd. And that's the feeling I have at the end of this discussion. I'm not clear what I'm certain about, but a lot of the doubts have been removed.